So when I was just starting out multifamily real estate, there were two words when put together, I hated them the most. It is cap and rate, or capitalization rate. Individually, the words are harmless, like this cap, or that cap. And rate is not too bad either. But when you combine rate with capitalization, it stresses out new investors. That's okay, because I was there too. That's why today, I decided to create the one video to rule them all and explain capitalization rate in as simple as humanly possible. Close to the end of this video, I will point out the single misconception that is the cause of all this confusion. So stick around for that. We got a lot to talk about, so let's get rolling. Let me first share with you what is the textbook definition of cap rates. According to Investopedia, the capitalization rate, also known as cap rate, is used in the world of commercial real estate to indicate the rate of return that is expected to be generated on a real estate investment property. See what I mean? Did that really paint a clear picture of the term? Were you less confused now than the version of you before reading that phrase? Alright, let's try again, but now let me share with you the simplified version of the definition. Alright, cap rate is simply defined as a way of measuring what investors are willing to pay for an income-producing asset. It's as simple as that. You can think of cap rates like a room thermometer. Yes, I said room thermometer, not like those fancy Nest thermostats. That's because a room thermometer can only tell you how hot or cold the room is. In a hot market, investors like to pay more for an income-producing asset. On a cold market, investors like to pay less. The main difference between a thermostat and a room thermometer is that a room thermometer can only tell you the temperature, while a thermostat can do that and change the temperature. That is a very important distinction that I will cover on later in this video. So you might want to ask, Adrian, why would we want to measure what investors are willing to pay for a certain asset? Great question. Let's move on to how cap rates are used. See, the way residential homes are valued is by looking through the past 6 months and checking which homes have been sold with a similar make and model of the subject property, which is also called recent sale comps. Let's say you're looking to buy a new home. And in this neighborhood, all the homes are those cookie cutter homes where everything else looks the same. Looking at the recent sale comps, you find that there was a house that was sold for $300,000. So it is reasonable for the seller to ask $300,000 for the same home. In large multifamily apartments, it is very difficult and close to impossible to find two apartment complexes with the same size, vintage, amenities, and in close proximity as each other. Which is fine and all, because those who are buying apartments did not buy them for its looks. Well, maybe a little bit about its looks, but they're more particular about its ability to produce income. And that is where cap rates come in the picture. Now that you know the definition of cap rate and how it's used, let's move on to the formula so we can apply it. The formula is very simple. Cap rate is equal to net operating income divided by the price. Alright, so let's break down the formula. We've already covered cap rate. Now let's talk about the two other components of the formula. Net operating income, or NOI, is the income produced by the property after deducting all of the operating expense, not counting the debt. Net operating income is arguably the most important number because it reflects how well or poorly the property is operating, therefore influencing the price. The last piece of the formula is price. Price has 2 points of view. You're either looking at the price as a seller or a buyer. Alright, so let me show you a quick trick on how to remember the formula. Draw a triangle and create 3 sides. Then write C, I, V in this order, where C stands for cap rate, I stands for NOI, and V, or value, stands for the price. I use the acronym CIV because there are a lot of words that starts with CIV, like civilian, civics, Honda Civics. Anyway, you already know where I'm going with this, right? If I have 2 of the 3 pieces, then I'm able to find the third piece. For instance, if I'm looking for the price, I just cover V and the formula is I over C, or net operating income divided by the cap rate. Likewise, if I'm looking for the cap rate, I cover C and the formula shows I over V, or net operating income divided by value or price. To solve for I, or NOI, I simply multiply the cap rate and the price. Now let's go over some quick examples. If a property we're looking to purchase has an NOI of $100,000 and the market cap rate is 5% or a 5 cap, what is a reasonable purchase price? Going back to the formula, since we are solving for the price, the formula is I over C, or net operating income divided by the cap rate. Therefore, a reasonable price to pay for this property is $2 million. Let's move on to the second example. Let's say this same property is underperforming or mismanaged and therefore producing a lower NOI of $80,000. Using the same cap rate of a 5 cap, the price is reduced to $1.6 million. Last example. Let's use the numbers of the first example. The property has an NOI of $100,000, but instead of paying $2 million, you paid $2.4 million. What is the cap rate? Using the formula, it is I over V, or net operating income divided by the price. You get 0.0416, or you bought this property at a 4.2 cap. Alright, let's talk about what just happened. Everything in this darker gray color is what we are solving for. The first example is our baseline. In the second example, we are solving for the price. We reduced the NOI, but the cap rate stayed the same. That results in a lower price. In the third example, we are solving for the cap rate. The NOI is the same as example 1, but we paid a higher price. That resulted in a lower cap rate. You're probably starting to see the relationship between the three components. Point 1. With the cap rate staying the same, NOI and price have a direct relationship with each other. Meaning, if NOI goes up, the price goes up. And if NOI decreases, the price decreases. Point 2. With NOI staying the same, cap rate and price have an inverse relationship. Meaning, if the cap rate goes down, the price goes up. And if the cap rate goes up, the price goes down. For those of you in the financial markets, cap rate moves like a bond. Because in a bond, when the yield goes up, the price goes down and vice versa. Point 3. If the price stays the same, alright, let's pause right there. Remember in the start of this video where I stated there's one misconception that causes all of the confusion? Well, this is it. If you haven't already heard this line, you will hear it sometime in your career. You will hear an investor say, we bought this property at a 5 cap, and after implementing our business plan, we were able to raise it to an 8 cap. That is why I mentioned the analogy of a thermostat versus a room thermometer. Cap rate is a room thermometer where it is a reading. The number cannot be manipulated by investors. Therein lies the confusion. That line basically states that after they implemented their business plan, the investors was able to raise the cap rates, which is not possible. Instead, what that investor was referring to is called the yield on cost. Because the price is fixed, they're trying to find out what is the new rate based on the improved income. It isn't considered a cap rate because there was no transaction, there was no sale, and no introduction of new capital. So going back to the diagram, instead of cap rate, we change it to yield on cost. Now with the price staying the same, the NOI has a direct relationship on the yield on cost. Point 4. You can simply say cap rate is an income multiplier. What I mean by that is that for every dollar gain or loss, there's a fixed price value that is also gained or lost. Check out this chart. In a 5 cap market, investors are willing to pay $20 for every dollar increase in the NOI. That is why in example 2, when the NOI is decreased by $20,000, its value dropped by $400,000. Woo, we covered a lot. But I tell you, this is the one concept that if you get it wrong, it can hurt you the most. If all you got out of this video is that CIV triangle formula and the table showing how NOI, cap rate, and price are related to each other, you are already more informed than most investors in the business. If you're looking to put your newfound knowledge to the test and want to find new investments, check out Cashflow Marketplace. Sign up for a free account to access active and future deals. You can view them at your own convenience and even place soft commitments. You are also free to browse and learn the process for when you are ready. Our network allows you to connect with over 50 experienced investors. Investing in commercial real estate made simple for the novice and busy professional. Finally, creating an account, investing in deals, and connecting with investors is absolutely free. Alright, that is it for today. I hope you found value in this video. I wish you all the best in your investing journey, and I will catch you on the next one. Bye for now.